Welcome to the fifth video in our series 6 of the video tutorials on technical analysis. In our previous video, we focused on the triangle formations as technical chart patterns. In this video today, we will be covering another commonly used chart pattern, that is the wedge formations. Wedge formation is quite similar to the triangle formation, and often the two are confused with one another. Through this video, we aim to clarify this confusion. Wedge formations are mostly considered as trend reversal patterns. Just like in the case of a triangle, a wedge is formed as a result of intersecting trend lines that are formed by joining various price data points. These are classified into the following two types: the rising wedge and the falling wedge. We will discuss each one of them in detail now. Starting with the rising wedge formation, a rising wedge is considered as a bearish pattern indicative of a selling bias. These are usually formed towards the end of an uptrend, signaling a trend reversal from buying towards selling. When identified in an ongoing or a newly developed downtrend, this pattern confirms the bearish bias. The shape of the wedge is wide at the beginning of its formation and converges further down as the price range narrows down with time. The components of a rising wedge formation are as follows. First is the top line of the wedge. This is formed by joining at least two successive highs of the series of peaks and troughs in a price move. These highs must be successively rising, and the associated volume with them should dissipate during the pattern formation. Next is the bottom line of the wedge. This is formed by joining at least two successive lows in the series of peaks and troughs in a price move. These lows must be successively rising. If the lows are formed at the same or lower price levels, the formation would be considered invalid. Now that we know how to identify a rising wedge, we'll understand how to use them while trading. A rising wedge formation is usually formed as a continuation to an uptrend, signaling its potential end. It is considered to have a bearish bias when each successive high formed experiences a loss of upside momentum. This can be identified by falling volume associated with the price move. A breakout of the prices below the bottom line of the wedge is considered as a sell signal. After the breakout, once the price falls considerably lower, it mostly attains its minimum objective below the bottom line. The minimum objective is the perpendicular distance between the top and bottom line of the wedge. Let's have a look on the trading platform to understand the formation and working of this pattern better. We consider the example of the euro-dollar over the 1 hour time frame. We identify the rising wedge formation here on the chart. As you would notice, this pattern emerged out of a newly established downtrend. These points here are the successively rising highs, and joining them would give us the top line of the wedge, while these here are the successively rising lows, and connecting them would give us the bottom line of the wedge. This completes our rising wedge formation. How this formation differs from an ascending triangle is that in the case of an ascending triangle, the top line is mostly a horizontal line, while in the case of a rising wedge, the top line is an ascending trend line with a positive slope. While an ascending triangle is a continuation pattern indicating a continuation of an uptrend, a rising wedge is mostly a trend reversal pattern, but when formed during an ongoing or a newly developed downtrend, as over here, it confirms the bearish bias. You would notice that the associated volume flattened and then fell during the formation of this pattern. indicative of the fading upside momentum during the formation. Once the price breaks out below the bottom line of the wedge, as in this region, it would be considered as a sell signal. The price is expected to drop to lower levels by at least the amount of the minimum objective, which is the perpendicular distance between the top and bottom line of the wedge. Notice how the volume dries up in the pattern and then increases at the breakout and picks up as the downtrend gains momentum shortly after the breakout. Next, we have the falling wedge formation. A falling wedge is a bullish pattern indicative of a buying bias. These are usually formed towards the end of a downtrend or in continuation to an ongoing uptrend. When formed during a downtrend, it signals a trend reversal from selling towards buying, while when identified in an ongoing or a newly developed uptrend, this pattern confirms the bullish bias. The shape of the wedge is wide at the beginning of its formation and converges further as the price range narrows down with time. Let's have a look at the component of a falling wedge. The top line of the wedge is formed by joining at least two successive highs of the series of peaks and troughs in a price move. These highs must be successively falling, and the associated volume with them should dissipate during the pattern formation. If successive highs are formed at the same or higher price levels, it would make the formation invalid. Then we have the bottom line of the wedge. This is formed by joining at least two successive lows in the series of peaks and troughs. These lows must be successively falling and would be associated with a fading volume during the formation of the pattern. Having identified a falling wedge, we now see how we can use it while trading. Since usually these are formed in continuation to a downtrend, a falling wedge signals a potential end of the downtrend. It is considered to have a bullish bias when each successive low experiences a loss of downside momentum. This is indicated by a lag or fading volume associated with the price move during the formation of the pattern. A breakout of the prices above the top line of the wedge is considered as a buy signal. The price mostly attains its minimum objective after the breakout above the top line. The minimum objective is the perpendicular distance between the top and bottom line of the wedge. Let's have a look on the trading platform to understand the formation and working of this pattern better. We consider the example of the AUD CAD, that is the Australian dollar against the Canadian dollar, over the 1 hour time frame. Here we identify the falling wedge formation. As you would notice, it is formed in continuation to an ongoing uptrend. These points are the successively falling lows, and joining them would give us the bottom line of the wedge. While these points here are the successively falling highs, and joining them gives us the top line of the wedge. This completes our falling wedge formation. You would notice that the associated volume with this price move during the formation of the pattern faded. Once the price breaks out above the top line of the wedge, it is considered as a buy signal. The price is expected to rise towards higher levels by at least the amount of the minimum objective, which is the perpendicular distance between the top and bottom line of the wedge. Notice how the volume increases on the breakout and picks up as the uptrend gains momentum shortly after the breakout. Since this falling wedge was formed in the continuation to an uptrend, it confirms the bullish bias of the trend. Had this pattern been identified in a downtrend, it would be considered as a signal of the potential end of the downtrend. So with this, we conclude this tutorial on the wedge formations and how you can use them as trade signals while trading. Thank you again for taking the time to watch this video.